The Federal Reserve's report came out earlier this year. The Fed's report was rather strange. We'll get to that later. The United States Federal Reserve. As expected, I thought the BIS truly understands CBDCs. After all, it overlaps with their own area of work. It's a long-established institution that coordinates interbank agreements such as the Basel Accords. Originally, during World War II, the US tried to dismantle the European-centric financial system by abolishing the BIS. There's always been talk of its dissolution, yet it has uniquely survived to this day. It's not a formal legal entity like the IMF. As far as I know, it's a highly distinctive organization. But this organization really dislikes Bitcoin. Here's a common misconception among those in banking. There is no global government. Is there a global government? Did one pop up without me knowing? No, there is no such thing. But those in the financial sector, especially those working in payment gateways, as some of you may know, they tend to assume there is a kind of global government, but there isn't one. A global government simply does not exist. So what we call a global government is really just an informal network of sovereign nations and independent central banks, each with its own history, loosely weaving together shared financial protocols. Of course, after World War II, the United States leveraged its overwhelming power, and while it made concessions in other global institutions, you can say it maintained a tight grip on global finance. Nonetheless, the roots are still European. This is the question we often hear. Will Bitcoin survive when CBDCs are introduced? That kind of discussion, right? So we need to define what a CBDC actually is. The IMF and BIS reports differ somewhat from other central banks' reports. They give considerable thought to the definition of what a CBDC actually is. Because if you just say it's digital currency issued by a central bank, it becomes confusing. Since people assume it's like Bitcoin, but it's actually nothing like it. In reality, it's very similar to online banking. Think about it, we hardly use physical money anymore. I'm going to a funeral after this talk, and I don't have any cash on me, but I'm not worried at all. A few years ago, you'd find an ATM nearby, but now we barely use ATMs either. You just sign the guest book and use online payment to send money. If it's a small amount, you might discreetly put it in an envelope and drop it into the anonymous offering box. But if it's a significant amount, it can't really be hidden, so you just send it online. Anyway, no one's carrying cash anymore. That's why systems like Visa or MasterCard are already fully digitized and functional online. So why do we even need CBDCs? That's a question many people ask. The second point is that central banks might directly issue currency to the public. But before getting into the global monetary systems, let me briefly explain how central banking works. When we talk about money creation, it's not simply about the Bank of Korea printing physical bills at the mint. When that money is distributed to the public, it's recorded as a liability on the Bank of Korea's balance sheet. It's treated as a liability, not as an asset. Think of it this way. The Bank of Korea is the only organization that gives out money and treats it as debt. It gives money to commercial banks, and when it does, it books that money as its own debt. That's what money is. What we call base money, the monetary base, is the debt of the central bank. So essentially, a central bank is the bank for commercial banks. Commercial banks are clients of the central bank. In terms of power dynamics, the central bank is clearly in charge. But formally, commercial banks are still considered the clients. So when we hear the term CBDC, experts immediately think, if the central bank issues it, does that mean individuals like me or Samsung Electronics will have accounts directly with the Bank of Korea? And would the central bank register that money as debt to Taemin or Samsung? That's the idea. That's one of the defining features of a CBDC. Traditionally, central banks provide what's called reserves to commercial banks, which in turn serve individuals and companies. But now what if they go directly to individuals and companies? To operate it on a blockchain, we need cryptographic technology. And I feel like I'm the only one emphasizing this right now. And whether or not cryptography is used, that's not even discussed in the BIS reports, nor is it mentioned in the IMF's documents. Are they actually using cryptographic tech or not? Why is this important? Because there's a big difference between authenticating the cryptographic key and authenticating the person. And when you use digital money at a bank today, are they authenticating you or the password? It's you, right? The system is built around people, not cryptographic logic. That's why identity is the most important information in finance, identity data. You truly feel this when applying for a loan. Information about your identity, job, and financial status. I recently took out a multi-billion one loan for real estate, and let me tell you, it was no joke. They've made the whole process so complicated, haven't they? Starting from income verification, just the paperwork alone is massive. The financial system verifies people, but if a CBDC were to resemble Bitcoin even slightly, it would mean not verifying people. Bitcoin doesn't verify people. If you've used Bitcoin only through an exchange, you might think it does verify people. But think about Bitcoin or Ethereum for that matter. There's no process to verify Taemin the person. It's the cryptographic key I hold that defines my access and authority. Whether or not CBDCs adopt this model, that's a critical issue. It's not just a technical question. It reflects the worldview of the people designing it. It conveys how they perceive the phenomenon of Bitcoin. It embodies their vision of the future and what kind of world they want to create. It's geopolitically significant as well. Point 4, will it actually use a distributed system like blockchain? Does that mean the central bank will actually give up some control? Like, will the Bank of Korea say, Worry Bank, here's a server for you. IBK, you take one too. And Kookmin Bank, here's yours as well. So let's all co-validate and share control. Would they do that? They have absolutely no intention of doing that. None of the CBDC models from any country show any sign of that. So fundamentally, CBDCs have nothing to do with blockchain. Will they choose not to control the rate and amount of issuance like Bitcoin? If point 4 is a no, then point 5 is obviously no as well. Let's say the Federal Reserve launches a CBDC, central bank digital currency, and claims this is governed by math just like Bitcoin, so we don't and can't touch it anymore. But honestly, no one would believe them anyway, given their track record. To make us believe, they'd have to make it truly like Bitcoin. They'd have to decentralize all the nodes, right? But since they're not even considering point 4, point 5 isn't even worth asking about. So maybe just points 1, 2, and 3. Do they use cryptographic technology? They don't. Then it's entirely disconnected from what Bitcoin and blockchain have unlocked, namely smart contracts. Even if you create digital money, you still need to use cryptography, but they're going to require identity verification. That's what it says, even in the BIS documents. Now here's a definition from the IMF. They laid out a few criteria. Is it issued by a central bank? Is it legal tender? Is it backed by a central bank, even if not issued by one? Is it pegged to legal tender? That's a stable coin. Then, can it be transferred from smartphone to smartphone without a third-party intermediary? Next, can it be programmed rather than just used as money? So they classified everything according to these 6 criteria. This framework was published 2 years ago. I thought, the IMF is smart, they've done their homework. That was my honest impression. This is how you study the subject properly. Cash meets all the criteria except the 6th one. It can't be programmed, paper money, right? Next comes R, retail CBDCs. When people hear CBDC, what comes to mind is usually the retail version. A proper retail CBDC must check all the boxes, issued by the central bank, legally binding, that's a given. It must also be stable. And because of cryptographic features, it should allow smartphone to smartphone transfers. There should be no need for third-party verification. With cryptographic technology, peer-to-peer transfers are possible. And finally, it must be programmable. Now, the real question is, will they actually deliver on that? Will this actually come out? It's not about whether they release something called a CBDC. We have to ask whether this specific version will come out. So since last year, I've been saying this version won't happen. But I'm the only one saying it, so people don't believe me. Now, the BIS finally acknowledges that CBDCs can cross borders freely. Bitcoin, of course, has no concept of borders. The BIS report now issues a warning about the risks of borderless CBDCs. First, can a CBDC that freely crosses borders really coexist with the Bretton Woods system, the post-World War II international monetary system agreed upon in 1945? They ask whether such a CBDC is compatible with today's global financial system, especially for economically weaker nations, though maybe not ours. But personally, I don't exclude Korea from that risk either. They say CBDCs could trigger local currency crises. Why is that? Imagine the Fed sends you dollars directly to your smartphone. Then you have a choice to make. Do you want to hold dollars? Or would you prefer to hold Korean won, which is steadily losing value? Sure, you'll need some Korean won for buying things locally, but you'll likely keep only the minimum needed. Would you hold won for more than a year? Probably not. You'd hold dollars, right? That's why I predict that. Japan, having endured long-term deflation, has developed a deflationary mindset, so the yen may be considered even safer than the dollar. Except for the EU and Japan, most central banks could collapse. If the Fed CBDC gets directly installed onto our smartphones, most central banks around the world will find themselves obsolete. Then even cafes will start accepting dollars. Why wouldn't they? Now, with free capital movement, if money crosses borders freely, the firewall that is the national border breaks down. Currently, we still have frictions like exchange rates and complex systems that burden users with high fees. These frictions act like valves that slow the spread of economic crises across borders, but those valves may soon disappear. This is all from the BIS report. Now consider the tools currently used to manage capital flows. You know, the ones who just sit there and make money off us doing nothing. And at the airport, these guys just stay put and rip us off without moving. They profit through bad exchange rates and pocket your leftover change while they're at it. All of this, including central bank systems and even things like SWIFT codes, they're referred to as capital flow management systems. They call it CFMS, Capital Flow Management System. But if a dollar-based CBDC crosses borders, these systems become powerless. And when that happens, governments lose tools to steer macroeconomic policy. Policy instruments for managing the economy become restricted. Even in Korea, where we've already liberalized a lot, those remaining controls will become meaningless because money is moving peer-to-peer directly from person to person. There's a chilling line in the report. This is the punchline in my view. The BIS report states the following, but if you can control the wallet, you can manage the system even more directly. So BIS, the IMF, and the Fed are all being very explicit about this. The CBDC they're envisioning is completely different from the one we imagine. First off, they probably won't use cryptographic technology, right? They'll verify identities instead. Then they might even integrate GPS tracking into it. So let's say I'm Korean and I hold Korean won. The moment I cross a border, my wallet could get disconnected. That's the kind of thing they're imagining. But the biggest issue is this: commercial banks go bankrupt. You all have accounts with commercial banks, right? Do you keep that account because it pays good interest? No, it's a checking account. You keep it because you can withdraw anytime. Does it pay much interest? Just a few one maybe. Then why do you keep your money there? Right? Because of online banking. That's the main reason now. We keep it there for the convenience of online banking. But if the central bank sends me CBDC directly, are you going to transfer that back into your commercial bank account? Of course not. You'll just store it on your phone and spend from there. Then banks lose their capital base because when banks issue long-term loans, they don't use long-term savings to fund them. They use short-term deposits to issue long-term loans. That's what a banking license is really about. How is a bank able to do that in the first place? Because when you deposit money with me, you don't withdraw all at once. Only one or two of you might withdraw at a time. So I only need to keep that much on hand, and the rest I loan out long-term at high interest. While paying you a few one in interest, that's how I make money. That license is what defines commercial banking. But according to Australia's CBDC report, 60% of commercial bank assets are demand deposits. That's just lazy people like me leaving money there, not because we care about the interest. It's just convenient because online banking works. But all of that could disappear. This is the biggest problem with CBDCs. Why? Well, if you look at the history of central banks, they were originally created as the lender of last resort for commercial banks. In other words, they are the ultimate backstop. In finance, you ultimately need a final guarantor. Because of how normal distributions work, rare events are supposed to happen very infrequently, but the tail of the distribution isn't flat, it's fatter than expected. Things that should happen once in a century happen every 10 years instead. Events beyond 3 standard deviations actually occur. And the problem is, when it happens, it's fatal. Just because it rarely happens. Does it make any sense to let your algorithm only run under normal conditions? If an attack triggers a black swan event, someone still needs to step in and stabilize things. History has proven this time and time again. There has to be a hand to hold. That's the role of the central bank. Even if it's rare, people still panic all at once. Leading to a bank run, right? That's when the central bank says, I'll give you unlimited credit. I've got you. That's why central banks were created. They were created with good intentions, but later got involved in all kinds of affairs, even personnel decisions. Anyway, central banks were originally created to support commercial banks. But if they launch CBDCs, they could end up wiping out the commercial banking sector. If the Fed creates a dollar-based CBDC, central banks around the world could shut down, along with their local commercial banks. If they still go ahead with it, then we're entering conspiracy territory. It would imply the existence of a global government if they did it anyway, saying, I don't care what happens to the world as long as the dollar survives, because the dollar is debt, it gets saved. And now it's not just institutions saving in dollars. Imagine billions of people around the world starting to save in dollars. Saving means not redeeming the debt, not cashing it in. The United States and its Federal Reserve is the only authority that can repay debt by issuing even more of it. They might still try it under the mindset, even if the world collapses, we must save the dollar. But even then, I don't think they can save the dollar. The BIS report describes CBDCs as a road no one has ever taken. Why has no one taken this path? We're looking at the present and the future. It's a triad of overlapping circles, a three-way system. First, it's about being issued by a central bank. Second, whether it's widely used for payments. And third, whether it's digital in form. Now look, if it's issued by a central bank and widely used for payments, that's cash. If it's not issued by a central bank, but it's widely used in digital, that's what we currently use, electronic banking, online banking. So even though we think money comes from the central bank, in reality, the central bank gives it to commercial banks, and commercial banks create credit from it. And that's what we mean by a bank account. This is electronic and related to central bank reserves. Think of it as reserve money. That's not for public use. It's between central and commercial banks. Now, what's missing from this picture? Something issued by the central bank, digital in form and usable to buy coffee at a shop. So when someone says CBDC, whether they realize it or not, this is what they're referring to. This is retail CBDC, retail level digital currency. Why is it called retail CBDC? Because that's the real CBDC, but institutions can't let it fully emerge. So they're going out of their way to draw distinctions. They say, that's our CBDC, what we're making is something else. So now we have MCBDC, WCBDC, etc. With someone setting up a gateway, placing a central authority in the middle, unrelated to Bitcoin, Samsung Pay handles all the credit card companies' data, and Samsung retains all of it at the gateway. At first, we use it because it's linked to our credit card balances, but over time, Samsung ends up with all the transactional data. Eventually, it's no longer the credit card company, it's just Samsung. Everything runs through Galaxy. No intermediaries needed. People say it's a security risk, but they already have all the tech for it. Then all existing security systems become unnecessary. Just use QR codes for everything. That's what this is. It's a system not issued by the central bank. A true CBDC must meet all three conditions, and that's what we need to consider. And this is a geopolitical form of money. If this comes out, it could shake the global order. That's why we need to think very carefully about this. When I read the Fed's CBDC report, it became clear to me that they've been thinking about CBDCs even before blockchain emerged. They delayed publishing it by half a year, and it barely mentions blockchain or cryptocurrency. Other CBDC reports at least talk about blockchain. They argue that crypto presents a challenge, so central banks should respond, but the Fed hardly says anything like that. Instead, they're worried about disrupting collaboration with commercial banks. I mentioned that earlier. That's what they're focused on. They're enthusiastic about stopping money laundering altogether because it means everyone's identity will be exposed. Clearly, anonymity through cryptographic methods isn't part of their plan. They expressed mild concern over individual privacy breaches. Even if we just buy a pack of gum, that gets recorded because it all gets logged in the central bank's database. But surprisingly, the Fed's CBDC report doesn't seriously consider the issue of cross-border flows. That's actually a huge deal. You could say that studying this very issue makes up half the curriculum. Why is cross-border money movement such a problem? You could argue that the Bretton Woods system was designed precisely to address that question. Dexter White and the genius Keynes spent years thinking about this. When they built the post-White's financial order, they gave each nation control over its own currency, saying, let's end imperialism, let all 150 to 200 nations manage their own currency. And let's create a separate settlement system for trade not based on gold, not gold, but something adjustable for political and economic needs, so that in a crisis we could flood the system with liquidity. During something like COVID, we needed to massively increase liquidity, but gold can't be printed. So they built a system that allows for rapid expansion of liquidity in emergencies, and to prevent hot money, speculative capital, people like Soros. Soros wasn't around at the time, but you get the idea, people like him. They wanted to stop speculative attacks on banks using short-term capital. Those guys do nothing good for the economy. So they built a firewall to prevent money from freely crossing borders. Only central banks or authorized banks could move capital across borders. Individuals had to convert currencies immediately during trade, and the idea was to discourage individuals from holding foreign currency at all. That was the philosophy behind the system. That's the very system we still benefit from today. Whether we realize it or not, that's the historical reality. So it's only natural that the US central bank, which led all this, should seriously consider cross-border issues, but they're not even thinking about it. So I thought, well, maybe they'll address it in volume 2 or 3. I figured maybe they'll cover it later. But then I had a realization, and I think it was a pretty deep insight. From the beginning, they had no real interest in blockchain or the borderless nature of Bitcoin. They just want to use GPS, like what Google already uses. You know how it shows your entire location history after a month? That's the kind of tech they're building digital money with. So borderless flow was never even a concern for them. Our money can't cross borders, and foreigners can't receive it. If a foreigner wants to receive it, they'd have to get explicit authorization and qualification. Only then would a dollar CBDC be sent to my wallet. Even an American can't take it across a border. If they do, it gets deactivated. And once they're back in the US, it reactivates. That's the kind of system they're thinking about. So what does this mean? The Fed's CBDC has nothing to do with cryptocurrency or blockchain. It's got zero relation to Bitcoin. That's why the BIS created this kind of diagram. Since retail CBDCs are too risky, they started worrying about foreign access. Foreigners receiving dollar CBDCs. It's a huge problem, but it all comes down to how the ecosystem is designed. If it's a closed system, like I explained, the Fed issues it. Only US citizens can use it, and it becomes invalid across borders. That's a closed model. Then there's the indirect model. You can use it abroad. Just like international phone roaming, we could build a roaming system for money. Let's build a conversion system for foreign exchange. Ripple wants to take over that entire system. But they know nothing about global systems or geopolitics. Ripple experts keep talking without understanding any of this. They ignore the geopolitical dynamics and say Ripple will just solve the inconvenience of currency exchange. They can't explain how, only that they say they will. So Ripple supposedly takes it all over based on assumption after assumption. And the key point is they completely ignore the rules of the geopolitical game. For geopolitics to be restructured, hundreds of thousands of people have to pick up guns, fight, and die. Geopolitics doesn't change just because of technological progress. It's something entirely different from social change driven by tech. When geopolitics changes, millions are orphaned, hundreds of thousands die on battlefields, and only through that crucible is a new order forged. It lasts for decades. And to change it again, blood must be shed again. Then a new order is forged once again. That's the terrifying part. Coders, listen carefully, even if you're respected now. You're only being respected in this upper layer order that lets you clock out on time. But those who don't get to clock out, They operate in deeper layers. I'm talking about the realm of soldiers and politicians, not from small nations, but major players like Russia and the US. Geopolitics is the game of Go they're playing, and in that world, there's no 6 p.m. clock out. That's the real order. Now about that direct, what did we say earlier about direct CBDC? Direct access. So what are they thinking? When it comes to how foreigners will access the system, they're thinking totally direct access. That means the Fed directly sends me dollars just like that to my smartphone with no intermediaries. So when someone says a CBDC is coming, think of this. Is this realistic? I mean, it could happen. But to conclude that it will happen, we'd have to accept that the entire geopolitical order would be shattered. You'd need to prove logically, step by step, that this order collapses. It has nothing to do with currency systems. You need to prove that geopolitics itself would collapse. To debate that, you'd have to read every book in this curriculum I've laid out and study with me through this semester. Only then can you say, this order is collapsing, therefore direct CBDC becomes viable. Then why shouldn't we expect a cryptographically secure CBDC? I wish a cryptographic CBDC would be introduced. What is a cryptographic CBDC? It doesn't verify that I'm Taemin. As long as I hold the private key, I can withdraw and use the money. That's how Bitcoin works, right? A CBDC like that probably won't be released, but I wish it would, because China dabbled with exactly that type of CBDC 3 years ago. They said they'd do it, but then completely changed their plans. They don't even call it CBDC anymore. They rebranded it as ECNY and said, this isn't a CBDC. They claimed it's not issued by the central bank. So basically, they backed down. They realized something. If they made it cryptographic, it would blow up in their faces. You all know Bitcoin is traded on Ethereum, right? There are several ways to do it. A third party can hold Bitcoin as collateral and issue Ether tokens against it. Or you can freeze Bitcoin with no intermediary, split the private key into N parts, and issue tokens one-to-one matched with Bitcoin. That's why they avoid cryptographic models. Let me explain a pretty complex concept. It's called atomic swap. You really need to understand this because the system built by Bitcoin, blockchain, and smart contracts is incredibly powerful. It's a far more disruptive technology than mainstream people realize. There are other reasons too, but atomic swap tech is one of the big ones. What is atomic swap? It's a system that allows interoperability between different blockchains. It was only theoretical until 2017 when it was successfully implemented for the first time. Bitcoin and Litecoin were swapped using a zero-knowledge protocol. What is zero knowledge? You and I don't have zero knowledge between us. We know each other's names and such, right? Let's say you're a drug dealer and I've got the money. A transaction made without mutual trust. That's what zero knowledge means. I don't know your background, your connections, none of it. Bitcoin and Litecoin were exchanged under those trustless conditions. And after that success, the system has continued to evolve. Here's the concept. This feature was already possible in Bitcoin, but it's been strengthened over time. They introduced a time lock system. If certain conditions aren't met within a set time, the funds get locked. It allows Bitcoin to be frozen. It becomes immovable. It's publicly known that it's locked. I can't unlock it myself, so the other party can trust the process. That's a very important idea. That's called a time lock. But it's not just about locking by time. Hash time locks are even more important. A hash time lock uses a hash value to time lock a transaction. So what is a hash? It starts with something called a pre-image. If I enter a number, say my password, it generates a fixed output. You can see the output, but it reveals nothing about the original password. That's what a hash is, got it? If you give me a hash value made from your password, I still don't know your actual password, but I use that hash to time lock a transaction. I lock the funds inside a digital safe. If I deposit funds in that safe, only you can open it because it was locked with your hash. And when you unlock it, you reveal your password to me. Then I take your password and use it to unlock what you locked. I unlock it, and before I can take the money, it's still under time lock. Even if I unlock it, the time lock remains. So I go first. I take the funds first, which then allows the other party to claim theirs. This kind of game theory becomes possible if you mix this with other technologies. First of all, you don't even need a bank. Banks are basically unnecessary in this setup. You can build a decentralized exchange. You say, want to trade your 20 Ether for my 1 Bitcoin? I say, sure, let's do it. You send your Bitcoin first, but if I send it, they could run off with it. Or if they send ETH first, I could run off with it. So it becomes a standoff. Nobody makes the first move. So what shows up to solve this? Escrow, a centralized intermediary, or let's call it an auction house. It says, you send me the Bitcoin, I'll hold it until the Ether arrives. That's what an escrow does. So far, a third party has always solved this through escrow, but now we don't need that escrow. So how do you break the deadlock? Hey, send your Bitcoin, I'll send you Ether. How do I trust you? You send Ether first, I'll send Bitcoin, but the deadlock gets resolved. Why? Because once I send, it's time locked. They send and theirs is also time locked. That's why we can trust each other, because everyone can verify that the funds are locked. Conclusion, is it just for exchanges? No. If dollars were cryptographically issued, we could lock those too. So that cryptographic key, technically imprecise, but let's explain it like this. lock the cryptographic key. Since the key itself is money, you break it apart. You divide it into n parts and distribute it. So China fearlessly built a cryptographic version of the ECNY, saying, we should monitor how people are spending this, but the money doesn't move. It just sits in one wallet. The hashed key gets tokenized and traded on Ethereum. 10 of these tokens equal 1 ECNY. That's how it works. The government can't even see it. To them, it looks like it's not moving. And that's the punchline. Alice wants to make a trade with Bob. She gets a hash generated from Bob's private key and builds one vault. Then she builds another vault using her own private key. Now there are 2 vaults. Alice created both of them. She holds Bitcoin Cash. So she deposits BCH in Vault B. Bob deposits Bitcoin into the vault Alice made. Since Alice made the vault, she can unlock it with her password and take the Bitcoin. But it's time locked. Bob sees the password Alice entered and uses it to unlock her vault. So once Alice takes her money, Bob can also take his. But Alice could choose to do nothing and deceive Bob. So what is atomicity? Because of the time locks, if Alice does nothing, she's stalling the transaction on purpose, basically trolling. She gets nothing, but neither does Bob. But that causes losses. So to prevent that, we give the transaction atomicity. Atomicity means it's indivisible. The transaction either fully happens or doesn't happen at all. If nothing happens by the deadline, the Bitcoin that Bob sent simply returns to him. That's time lock simple, right? If you give me your pre-image, and I already know the hash of that pre-image, I can create a vault using a hash lock with that value. While you're unlocking your vault, I observe and use that same key to unlock mine and claim the funds. That's it. That's the whole concept. But to explain this to non-techies, especially humanities majors, you need 2 safes in the metaphor. So here's how I explain it. I'm a gangster, and so is the other guy. I have illegal gold bars, and the other guy has US dollars. We agreed to a deal in the underground world, but I don't trust that guy. I don't even want to meet him. He might shoot me. So we find a special kind of vault service provider, a hash vault provider. The hash vault operator has safes installed everywhere like public phone booths. There's a vault outside Taemin's place where the gold is, and another one in Garibong where the dollars are. But the vaults are special. Each has a camera inside and one outside that monitors the keypad. I go to the vault provided by the hash operator and deposit the gold bar. But at that moment, I turn off the external camera. Then I place the gold bar into the vault and lock it. I set the password myself. This vault is unique. When I set the password, it automatically generates a hash value. And then I turn on the camera. Once the camera is on, the other guy at the phone booth style vault in Garibong can see via smartphone that the gold is placed in the vault because there's a camera inside the vault. And what else do they see outside the vault? The hash of the password is displayed. He puts his cash in his vault. Then I can see it too. You can't turn off the camera inside the vault. That's a setting put in place by the hash vault provider. He locks the dollars in. This vault is special that he has to enter the hash I originally sent. That's the first lock. It's locked with the hash I gave. At the same time, he sets his own password. Then he turns on the camera. Now I leave my neighborhood and head to Seoul. And he comes to my neighborhood. We both arrive at our respective vaults. I go first and withdraw the dollars. As I'm retrieving the dollars from us, it matches the hash value I originally set. If I enter the correct value, the hash unlocks the vault. Ding, unlocked. Now, the guy waiting to grab the gold has seen this, right? What did he see? He saw the password being entered on the vault. So what if he enters that password, opens the vault, and runs off with the gold? That would be a total betrayal, right? But it won't work. The vault is time locked. That's why I have to inform him when it's safe. If you want to retrieve the gold, you use the password on your smartphone. When the vault system asks, what's the next password? You input the one I gave you. Enter it correctly. Ding, the vault opens. You retrieve the dollars, and as that happens, the other guy sees me unlock it and uses that same key to open his vault and get the gold. No trust is needed here at all. All you need are 2 special vaults. That's what atomic swap is. You need to understand this. It's about cross-chain asset exchange. That's the narrow definition of atomic swap. You can trade coins across chains on decentralized exchanges if you stretch this over time and break the cryptographic key into tiny fragments. You can divide any crypto asset and enable cross-chain equivalents as long as people accept them as such. Of course, some technical issues need to be resolved. For example, if you split a Bitcoin and issue 100 tokens against it, once you collect all 100, you can open the vault that holds the full Bitcoin. Then those 100 tokens would be considered equivalent to 1 Bitcoin. Would this be accepted as 1/100th in the ecosystem? Or would it trade at a premium? That, I don't know. That's up to the market. But if it trades 1 to 1, then it instantly unlocks the full Bitcoin when deposited. The key concept is using hash time lock technology from atomic swap. You lock one asset on one chain and move value elsewhere. Lock the other side and move across it. But if you only think in terms of safes, you're limiting your imagination. This vault analogy is just for beginners. It's not my invention. I read this from someone else's explanation, but I can't find the original source. It's something I studied long ago. But here's what matters. The vault metaphor was created as an allegory to help lay people understand, but the principle is exactly the same. It's really quite simple. I take the password you gave me, and with its hash value, I create and lock the vault. Then I watch you unlock it. When you reveal that information, I can use it myself, and that's what enables the swap. Think of the online state like a phone booth setup. We're not both online or awake at the same time. While I'm asleep, the other party could act. So we set tight time locks to prevent that. Just because you unlock first doesn't mean you can grab the funds first. You can only access your side after the other party does. This is how Lightning Network works, hopping through multiple users. As money transfers, the time locks are configured to release sequentially. If two users want to transact but don't have a direct channel, and there are 9 intermediaries between them, the 9 time locks are configured like this. They unlock in timed order, earlier to later, ensuring smooth, uninterrupted flow like water. Think of the timing structure like baffles in a waterfall, guiding the flow downward. With this structure, many different technologies have been proposed, like submarine swaps and others. But they're all based on the same core principle, locking funds with time. And why do we do that? To guarantee atomicity of the event. In insurance, there's usually a middleman. You sign up for a policy based on the assumption that the middleman won't go bankrupt. That's what makes the contract valid. But if there's no middleman and the insurance is just code, then after I pay, I need at least 10 participants to make it meaningful, but only 9 show up. I need to make sure I don't get stuck in a deadlock where I can't get my money back. To preserve atomicity, if 10 people don't join by a certain time, I should automatically get refunded. That's the only way I can trust the system enough to send money. That's why in smart contracts, defining the atomicity of an event is crucial. It's incredibly important, and it's an art, really. The art lies in how you define atomicity and apply time locks, like placing one-way valves in a bloodstream to prevent backflow. Then seamless transactions happen between many parties under zero knowledge. It's these powerful underlying technologies that define this ecosystem. So when governments toy with Bitcoin-like ideas, they're playing with fire. I've been warning about this for years. And now reading government CBDC reports, it's clear they have zero intention of using real cryptographic tech. Which means, in the end, they're just going for full identity verification. I'll have to prove I'm Taemin just to use a CBDC. So what kind of world are they trying to build? That's the real question. They're steering us toward a world like the one described in The Death of Money by James Rickards. Rickards is deeply skeptical of the global financial system and has been writing about it for years. He discusses this exact idea in the book, which was written before the COVID pandemic, published in 2016. And he's not some conspiracy theorist, not at all. But what he says sounds strikingly similar to what conspiracy theorists claim. He argues that global financial elites are plotting something major. They're preparing for a full-blown financial freeze, a kind of global New Deal, a hard reset for the entire planet. Ever heard that word tossed around, reset? And there's a shocking line in his book. He's not a Bitcoiner. He doesn't even like Bitcoin. He's skeptical of it. They were all set, but then Bitcoin showed up and threw everything off. But what were they preparing for? They wanted to roll out negative interest rates and control where your money could be spent. They were designing programmable digital money. Keynesians prefer fiscal policy, while monetarists prefer monetary policy, but they're really the same. Both camps favor inflation when you break it down. Inflation erodes pensions, it chokes the retired. Young people go out, create value, and generate income, but then they're told that belongs to creditors or that's the capitalist's cut. Eventually, the young stop working. Why bother? If you want to revitalize society, you have to suffocate the creditors. They need to be economically euthanized. Usually, they're the elderly, those who once contributed, but now must be phased out. And one of the best tools for that is inflation or fiscal policy. It's about running fiscal deficits. The government goes full tilt on deficit spending, but that debt piles on the cost of issuing government bonds. America is an exception, but even the US has its limits. If any country other than the US runs deficits recklessly, their bond interest rates skyrocket and nobody wants to buy. Spreads blow out. You've heard that term, right? Spread? It refers to the difference in 10-year bond yields between countries. That spread widens based on national creditworthiness. If bonds don't sell, the country enters a downward spiral. Fiscal deficits, governments are unique in that. They can repay current debt with future debt, and repay that future debt with even more future debt. That's why all 10-year sovereign bonds are effectively perpetual. You repay one by issuing a new 10-year bond, right? So it's basically a perpetual bond, but there are still limits because it's government debt. And we all feel the effects of monetarist inflation. Look what happened during COVID. That's central bank debt via inflation. Now imagine the digital wallet under my name, Taemin. They say, use it or lose it, will apply negative interest. Then I'm forced to spend. The stimulus effect is the same as deficit spending. The consumer spending boost is the same. But does government debt increase? Nope. No increase in public debt, no balance sheet risk for the central bank. Perfect. And on top of that, terrorists, we've flagged this item. It's made by counterfeiters. Then your wallet simply won't let you pay for it. Payment fails. It's pinpoint control. It's all written right here. At first, I thought this was just a conspiracy theory. I read about it a long time ago. I used to think it was just a conspiracy theory. But then I read the Fed's report and chills ran down my spine. So I reread it and it was shocking. Looks like they really were thinking this way. But then I'll hope Bitcoin stepped in and blocked it. Bitcoin totally threw a wrench in their plans. Or is that also a conspiracy? Shall we wrap up here for today, everyone? It was great seeing you all. See you again next time. Thank you very much.